Morning all. Yeah, morning. Hi. Good morning, everyone. Yeah. So, how was the BFM paper? BFM okay? Yeah, sorry, ABM. Yeah. All. Chalo. Good, yeah, good. Congrats. Congrats, yeah. Oh, good. Everyone has got good marks. Yeah, very good, yeah. So, focus now on BFM. BFM cleared, then it's retail it is a bit easier. BFM is the toughest one. Okay, let's start without wasting the time. Okay. So right now, see here, we are in the case studies batch, but some theory I'll definitely explain you. Why? Because paper is not only based on case studies, it's based on theories also. And right now, this today morning we'll be doing theory only about module A. Okay, important ones which I have taken out. Facilities to importers and exporters. In India, export trade is regulated by DGFT. See here, DGFT means Directorate General of Foreign Trade. Okay, this basically control. This is like the RBI. The RBI we have for banking, for export import we have DGFT, which functions under the Ministry of Commerce and Industries of Government of India. Okay, no more details required. See here, only one important part about DGFT is IEC code is given by DGFT. That's the only important part for CAIIB. Okay. And DGFT, what does it do? It gives various promotions for export and import, and that's it. It helps export and import and controls it. Various controlling agencies for export import in trade are as follows. The policies and procedures are to be followed, required to be followed, are announced by DGFT. So how the export and import is to be done? That is done given by DGFT. Financing of export trade and facilities granted under FEMA are governed by RBI guidelines. So financing is governed by RBI. Prescribed guidelines and rules of FedEx, a non-profit organization formed in 1958 with the approval of RBI. See here, what is the difference between DGFT and FedEx? Okay, this also gives process and policies and processes. It also gives guidelines. So what is the difference between DGFT and FedEx then? See here. DGFT controls overall export and import. FedEx mainly gives the point regarding rates and what are the banking related queries. Those are solved under FedEx. And DGFT, not only banking, but related other things also, like finding the customers abroad, finding the good shipping companies. All these things are done by DGFT. So overall management is done by DGFT, and FedEx does only related to finance. And remember, FedEx is a 100% under RBI. Okay, a non-profit organization formed with the approval of RBI. So the rates which we get in the bank every day, okay, those rates are given by FedEx. Okay. Now, how does the business take place actually? Export-import business takes place. Morning, everyone. How does the export-import business takes place? Mainly related to CIB. Okay. So here, export-import business takes place in four different ways. Okay. One sec. Let me write it. What are the four ways? Here, always first it is advance payment. Advance. Okay. Advance payment. Now that is quite simple. Under advance payment, what happens? If I myself and yourself are doing the business and I am the seller, then I'll be demanding complete advance payment from your side, and then you'll be paying me, and then I'll be sending the goods. Okay. Now, what is the risk in this? The risk in this is myself is in the different country. You are in the different country. Tomorrow, if you send a payment and I I don't send you the goods, then where will you fight the case? And international cases are very difficult to fight, because what happens? They take a huge time, because various countries' jurisdictions are separate, their laws are separate. So that's why advance payment is riskier for the buyer. Then second one is what? Second one is open account. Open account. Okay. Open account means what? Here the buyer and seller, look over here. The buyer and seller, here the buyer and seller, this is the buyer, this is the seller. They do the transactions outside the banking channels. Here, there is no bank involved in this. Only buyer and seller are involved. What do they do? This seller sends the goods back to the buyer. Buyer sends the payment. Now, while sending the payment, there only banking channel is used in open account. Otherwise, sending the documents, nothing is used under banking system. Okay, means suppose if I am the seller, you are the buyer, and we have this open account system. What will we do? I will send the documents and goods directly to you, and then you will send the payment through banking channel. So the bank is used only for payment. Okay, that is second point. Third is this collections. Collections means what? Now here the banking role comes in. Collections. Collection is under two types. Okay, one is site, second is usance. Okay, usance. Somebody calls it DP, DA also means I'll write it DP. DP means delivery against payment and DA means delivery against acceptance. Acceptance, okay? It means what? In collections, if the payment terms are site or DP, then it is, see here, I'll sell the goods. Look at this figure now. I'll sell the goods to you and immediately on seeing the goods and the documents, see both the documents and the goods will be sent by me. Immediately on seeing these goods and documents, you will send me the payment. Now here the banking channel is used. Main role comes over here is of the bank for documents. See here, goods are always sent via C only, but the documents are sent via bank in collections. So bank won't give the documents to that buyer unless that buyer gives a payment in terms of site, or if it's a usance, the buyer needs to give an acceptance. Okay, either payment or acceptance. Only in these two terms, bank gives the documents to this person. So what is the risk then? If we are doing such a thing, bank will only give the documents if the payment is received or acceptance. Then what is the risk in this? The risk is, suppose if this buyer does not pay, okay, if this buyer does not pay, then what will the bank do? Bank will take these documents, keep it with themselves, and what will they do next? They will send the documents back to the seller. Now imagine you are the seller over here and you have sent the goods, prepared the goods. These goods are generally for more than 10 crores. If you have sent the goods and this buyer doesn't pay and all the goods are returned to you later, right? There is no financial loss to you because the goods have been returned. But the problem is, what will you do with those goods, right? You remember one thing happened 2 months back with this Indian, I think so, wheat. Yeah, wheat was sent by India to various countries. So Turkey refused to take the shipment of that wheat, stating that it is of bad quality. So what happened after that? The Turkey sent the wheat back to India, but in India, what happened in between? This India, we sold this ship immediately to Egypt over there. So that's why we were safe. But these things happen in collections. Okay. So what is the safest way? Safest way is LC, letter of credit. So under LC, what happens? It is fourth. This is the main payment mode. Okay, LC. You need to know all these four payment modes. Here in exam, they will ask you about collections or LC. They generally don't ask you about open account. Okay. But you need to know what is the role of bank in open account. It's only payment. Only payment role in bank. Otherwise, bank has no role in this open account. Under LC, what happens? This buyer goes to issuing bank, his bank. Okay. Now, what does this bank say? His bank tells this seller over here that, see, you send me a set of documents, means which are the documents? I'll give you the main documents over here. See here, we are in the fast batch. That's why generally I don't give these things on the first day only. Which are the documents here? Invoice. Who can give me, who are there in the regular batch? Who can give me the documents? What are the 6 documents which we have generally? Yes, who are there for the earlier batches? What is it? I used to call it 2I, correct, correct. 2I, 2I, 2B, and last one is PC, correct, PC. Even if you remember these documents na, and understand these documents, then also 3 to 4 marks of yours are clear because you will get one question on either of these documents. Invoice, insurance, okay, bill of lading, or bill of lading, and bill of bill of exchange, okay, exchange, and last one is packing list and COO, certificate of origin, okay. Now, what are these 6 documents? I'll just give you in brief what is required to you in exam. Only that much I'll tell you now because the document itself has 1 hour lecture on each one. Okay. So invoice is prepared by whom? It is prepared by the seller. Okay. Whenever you go in, purchase anything, suppose you go in a mall, who gives you the invoice? You give the invoice to that guy or that guy gives the invoice to you? That the seller always gives the invoice, right? So invoice is always prepared by the seller. What about insurance? Say this. Insurance, there are 2 parts which are asked in exam. One, minimum insurance. Always remember, you'll get one question on minimum insurance. Okay. Minimum insurance is what? Anyone knows? What is the minimum amount of insurance we take it? Minimum insurance for exports. What is the minimum insurance? Percentage. Minimum percentage of insurance is, remember this, 110%, 110. Okay. That is as per UCP norms. UCP means Uniform Customs and Practices for Documentary Credit. I'll write it over here. UCP. DC we call it, but generally we call it only UCP and 600. This is the latest version of UCP going on. Okay. So Uniform Customs and Practices for Documentary Credits. Everyone write it down if you want. Okay. Uniform Customs and Practices for Documentary Credits, and 600 is a version going on. So there are 39 rules under UCPDC. Okay. Those 39 rules mean suggestions they call it. They don't call it rules. So these 39 rules are used in the international trade for doing any type of export or import. Okay. So insurance, minimum insurance is given as 110%. Number one. Number two, there is something called as in insurance that is called as TPND losses. TPND. Okay. What is TPND? TPND means theft, pilferage, PIL, pilferage, N means and destruction. Okay. Destruction. That is called as TPND. So these 2 things are asked to you in exam regarding insurance. Minimum insurance is asked and TPND losses are asked. Okay. So TPND means this, you get it in your bike insurance also, bike or car insurance. You will have this word of TPND. Okay. Chalo, move on. So because otherwise what happens, it's a huge big lecture on this. Bill of lading. Bill of lading is given by whom? The shipping company. Always remember 2, 3 important points about bill of lading. Okay. So the important points are, bill of lading is given by the shipping company. I'll write it over here. One second. Let me prepare get one slide over here. Yeah. So bill of lading is always prepared by number one, shipping company. Shipping company. It is a second point about BL is, it is document to title. This is very important. Document to title means the one who is having the bill of lading can get the goods. Okay. It's like that blank check, the bearer check. Okay. So second, third, it is negotiable. Negotiable. Okay. Remember, this is all regarding BL. Okay. BL. Bill of lading. It is given for the number fourth. It is given for C only, means shipment by sea. sea or ocean. Okay. So it is basically for under BL is given for sea or ocean. Then what is given for air? For air it is airway bill, AWB. Okay. For road it is either truck receipt, truck. Okay, truck receipt or lorry receipt. Railways we have rail receipt, rail. Okay, we call this rail receipt also. We call it rail receipt. Okay, and last one we have is for post office, post or courier. Means if I send the goods through courier or post, then it is PP, post parcel they call it, post parcel. Okay, and any shipment, any export you do, you need to have one document that's called as SDF. I'll come to that later now. Okay, SDF. So this is regarding BL. Remember, given by shipping company, document to title, negotiable, and sea or ocean. And fifth important part, it is always consigned. Consigned. Okay, consigned means who can take the goods. Consigned to the order of. Consigned to order of LC issuing bank. LC issuing bank. Okay, it is always consigned to the order of LC issuing bank. Okay, remember this. Why? Otherwise, what happens if it is when the seller sends the goods, the shipping company gives the BL to this seller, and if it comes in the hands of this buyer, then buyer will take the goods without paying to the bank, issuing bank. Okay, so it is always consigned to the order of issuing bank, and then issuing bank negotiates it and writes it on the back that kindly pay the goods to the buyer, this person. Okay, okay, move on. Bill of lading done, bill of exchange. Bill of exchange is other word for bill of exchange is draft called as. Okay, draft means say this bill of exchange means draft, BOE, BOE. That is called as draft. Second word for the in exam, any word might come to you, bill of exchange or draft. Okay, so it is basically the financial instrument. Draft is of two types. Okay, sight or usance, sight or usance. Okay, usance means and sight means what? Sight means immediate payment, DP, right? See this and pay this, immediate. And usance means future date, means 60 days, 90 days. These are generally the two terms used in usance payment, 60 days and 90 days. Okay. So you see this bill of exchange, give an acceptance now. Present, just now you give the acceptance that you will pay on 60th day or 90th day and pay on that day. So that's why I give this over here somewhere that site and usance. Okay. So that is the main point about this bill of exchange. Packing list. Packing list. Yeah, no major questions are asked. They are prepared by the seller only. It shows you, it's like that railway ticket. Suppose if you want to find somebody in your train, somebody is coming. Okay. So if you want to find that person, will you search the whole train? No. You will search the ticket number. Check the ticket number and go to the bogie number, right? Similarly over here, packing list is like that ticket. Whenever you want to find the goods in such a big ship, in that case, what happens? You directly go to that separate compartment. Then certificate of origin. COO is always given by the Chamber of Commerce. Remember this, Chamber of Commerce, COO. Okay, COO. Some question might come on COO. Okay, it is on Chamber of Commerce, given by Chamber of Commerce. What is Chamber of Commerce? No, it's actually not asked to you in exam, but Chamber of Commerce is the group of learned person in that city, okay, or in that area. So they issue the COO stating that whether the goods have originated in India or not. Origin, okay, origin in India. We nowadays see everything everywhere we say made in India, right? Make in India, made in India. So that certificate is generally given by Chamber of Commerce. Okay, got it? Okay. So let's come back now. What happens is the seller prepares these documents. Okay, all these six documents he gets it, and then he gives it to his bank. That is called as negotiating bank. NB, negotiating bank. Negotiating. Okay, and then this bank pays the seller immediately. Pays the seller. Negotiating means it pays immediately, and then it sends the documents to the issuing bank. Documents are sent. So Once the documents are issued by the issuing bank, it will pay to the negotiating bank. Okay. So there are four roles now of this bank. One is negotiating, second is confirming, third is this forwarding bank. Okay. These and fourth is nominated bank. See, these four names are asked to you in exam. One sec. These four names are asked to you in exam. What are the roles of each bank? Okay. One is two main are asked to you. I'll just confirm that only. Confirming bank. Confirming. Okay. Confirming bank. Yeah. What does confirming bank mean? Say this. Confirming bank means basically the bank who gives an additional payment guarantee. Means when the issuing bank gives the issues the LC, it gives a payment guarantee. Now, if one more bank gives the payment guarantee, that is called as confirming bank. Generally, remember, confirming bank is in the country of the seller. Issuing bank is in the country of the buyer. Okay. So confirming bank, it gives additional payment guarantee. Additional. Okay. Additional payment guarantee. Okay, that is the main role of confirming bank. Then what is second question which is asked to you is negotiating bank. What does it do? Negotiating bank. What does it do? Negotiating bank pays immediately. Remember, pays immediately. Okay, immediately. So now understand the difference. Negotiating bank pays immediately, confirming bank gives additional payment guarantee, but it does not pay immediately, confirming bank. Okay. And last one is nominated bank. These questions are only asked to you. Nominated bank. Nominated bank. Okay. Nominated bank, what does it do? If the name of this confirming bank or a negotiating bank is mentioned in the LC, see, a nominated bank is not a separate bank. Its name is, if these two banks' names are mentioned in the LC, then these banks are called as nominated banks. Suppose if Citibank issues the LC and it states that for this, that kindly uh, discount this LC through confirming bank only or trade through SBI only. So SBI becomes a confirming bank. Okay, move on. Chalo. So what happens then? Negotiating bank, these four roles are done. Seller sends the goods to this negotiating bank sends the goods to this issuing bank. Okay, now move on. Import-export code. Every person, firm, company engaged in the export-import trade has to apply or obtain import-export code from the DGFT. The various declaration forms, are export made otherwise by post, means anything except post. We have to give it this. What is the form required? From the customs house. That is called as GR, but GR is gone now. Everything is SDF now. Look at this SDF. GR was there when there was no interconnectivity. Nowadays, where shipping bills are processed electronically, everything is EDI system. Like we have this CBS core banking system. Similarly, in customs house, it is the CBS of core banking is EDI. Okay, interconnected all these this customs houses. So nowadays, everyone gives SDF form only. Now, what is this SDF form? See here, the important part about SDF form, which is asked in the LC in the exam, is SDF form is issued only for goods above USD 25,000. Remember this part, okay? So SDF form is issued only for goods above USD 25,000. Only here it is issued. Remember everyone, okay? I'll write it over here. Greater than 25,000 USD, 25K dollars, okay? Not rupees. So any shipment or any export below 25,000 USD need not have SDF form. Okay, this is for exports. Now, second, this see here, these forms are given by customs house. Okay, means these forms along with these six documents, they are to be submitted by the customer to the bank. Whenever that bank comes for export finance to you, he must have these six documents plus this one document. So seven documents he should have. Okay, so move on. So SDF form is there, and if anything is done through post, the post or courier, then PP form is used. Okay. Now for goods in non-physical form means this software. If it is software, then Softex form is used. Remember, for software it is Softex form. Got it? These are the three important forms which are asked to you: SDF, PP, and Softex. Okay. The exporter is required to submit the export documents along with a duplicate copy of GR-SDF form within 21 days from the date of shipment. So all these documents, these 6 documents plus one, this 7, these are to be submitted by the exporter to the bank within 21 days from the date of shipment. Remember this date, 21 days. Okay, 21 days. Here there are 3 days which are very important to you. They come in exam. One is this 21 days. Second, for checking the documents, how many days the bank has? The bank has 5 banking days. Remember, 5 banking days. So these are the main 2 days. And third one is the shipment date, means latest shipment date. So and expiry date. So that is separate. That is rarely asked. These 2 days are very important. 21 days and 5 banking days. Okay. Export proceeds of goods goods exported to warehouse established outside India for sale in other countries should be received on realization of sale proceeds, but within 15 months from the date of exports. Here, there are 2 months again which are important to you. If the goods which you send to outside a country, if they are sent to a warehouse, then the money should be received within 15 months from the date of export. And if you send it to some individual, like some company, individual means it's not a human being, it's a company. Suppose example, I'll send the goods to, let's say, Amazon. Okay. So Amazon USA. So if I send the goods to Amazon, Amazon, what does Amazon do? Amazon will keep it on their platform. And once it gets sold, then it will pay me back. So the concept about Amazon is warehouse. Amazon is similar to warehouse. But if I send the goods to, let's say, Google, okay, some goods to Google. So Google is an entity. It won't keep it in the godown. It will immediately consume it. So if you send it to an individual other than warehouse, then the money should be received within 12 months from the date of shipment. Okay. 12 months from the data. That is important. Okay. If the bill is not realized within the time stipulated, the exporter should apply to this AD for the extension of time with ETX form. Extension form means if the payment is not received within 12 months from the date of shipment, okay, then ETX form needs to be submitted by the this exporter. He needs to come to you, and there is a format of ETX. He needs to submit it to you that please give the extension. But what do we do? We don't take any action on this. Okay. SDF, it's not EDF, SDF form. Okay. We don't take any action on this. We send him directly to RBI. We just stamp it and then tell him that get it done from the RBI. Okay. So extension is mainly given by RBI. Okay. Next, all overdue bills which are not realized within the due date should be followed up vigorously and reported to Reserve Bank of India in a half yearly statement, XOS, to be submitted by the AD branch from June and December. See this. XOS is always submitted for export. What is XOS? XOS is means whatever bills have not been received, been paid. So those bills are to be reported to RBI. But this process needs to be started within 6 months. See here, what happens is RBI has given the time limit of 12 months for normal exports. But as a bank, we need not wait for 12 months. What should we do? We must immediately start after 6 months if the payment is not received and report it to RBI. See, this person we had sent the goods, but the payment is still not received, even though 6 months have passed. Okay, so that is for XOS. Similarly, now as we have this for XOS, we have for imports also. Okay, imports, there is a BEF report. This is for exports. For import, there is a BEF reporting. BEF reporting means bill of entry. Okay. In bill of entry, that is always half. Means if this XOS is for 6 months, bill of entry is for 3 months. Okay. Now there are two parts about BEF also. I'll clear that also now only. See here, what happens, because what happens, we are now in the 7 days batch. So when does the time come back on this topic? We don't know. So remember, whatever we remember, immediately we tell at that time only. So regarding this XOS or exports, this SDF form is about 25,000 USD. So BEF reporting is always above 1 lakh USD. For import, BEF reporting is above 1 lakh USD. For SDF form, it is export it is 25,000 USD. For import, it is 1 lakh USD. Okay, number one. Number two, SDF form means this export is to be tracked after, means money to be received within 12 months. But import, the goods to be received within 6 months. Everything is half for imports. Remember, goods to be received within 6 months. Okay, and this tracking XOS form is to be started within this 6 months, but BEF reporting is to be started within 3 months. See this, both the things are half for imports. Okay, BEF is in 3 months, XOS is in 6 months. XOS target is 12 months, imports target is 6 months. Okay, that is the half yearly. It is always half. Everything is half for imports. Okay. Following countries are under Asian Clearing Union (ACU). So Bangladesh, Burma, Myanmar, Islamic Republic of Iran, Pakistan, Sri Lanka, and Nepal. So these countries are under ACU. Now, what is ACU? Asian Currency Unit. That is called as ACU dollar. Okay. ACU dollar means what? It's not that separate, it's a separate dollar. It is just a combination. Means what happens? All these six countries have decided that what we'll do the exchange between each other, and whatever is the net result, that only will report it to RBI, to this US. Remaining things we won't report every transaction to US. Okay, that's called as ACU, Asian Clearing Union. That is a combination of six countries. Of course, it doesn't work much now, but for CAIIB exam, it is there. Otherwise, practically, it's of zero use now. SU. Okay. Now we have BRICS. BRICS has come up hugely. BRICS means, what is BRICS? Anyone knows? BRICS. Brazil, Russia, India. Then C is China, and S is South Africa. And now Saudi Arabia is joining. Okay. So that is BRICS. That has come up with as a huge organization now. Okay. Next. AD can approve reduction of export proceeds to the new exporter if satisfied about the genuineness of the request. Now, what is this? Suppose if I am the exporter, I come to you, okay, and tell you that, see, I have exported the goods, but this buyer is not paying me full amount. I have exported the goods of, let's say, $1,000. Okay, so kindly reduce my invoice amount. So and report it to RBI that we have reduced this amount. So how much amount can this bank reduce? The reduction does not exceed 25% of the invoice value. So you can't give the reduction below USD 750. Okay, if the invoice is of 1,000. But this is for new exporter. Okay, new exporter. Okay, the reduction is not in respect to the commodity subject to MSP, minimum price, means this wheat and basic commodities which are there. You can't reduce the price in that. Okay, it should not be related to MSP, minimum support price. Okay, third one is export should not be exporter should not be in the caution list of RBI. Now, what is this caution list? RBI always gives a separate caution list for all the exporters. Means these exporters are not to be dealt with by the banks, or they should not deal with these exporters. Okay, type the form name for import. Form name for import is BEF, bill of entry, BEF, bill of entry. Okay, bill of entry. Okay, got it. Move on. Yeah. So that's called as BEF. And what is the reporting? Reporting is called as BEF reporting. See here, for export, the names are separate. See here, there are two names for export. One is SDF, that is the form, and XOS, that is the reporting for exports. But for imports, everything is simple. BEF is the form and reporting is BEF reporting with the same name. Okay, that is the difference. For exports, it is the names are different. SDF and XOS. Okay, clear? Move on. Yeah. So reduction does not exceed 25% of this. Okay. Now this is for new exporter. Remember this word new exporter. 25% of the invoice value. Now if it's a old exporter means Reliance comes to you and Reliance says that that other person is not paying me. So AD can approve unlimited reduction in export proceeds for regular exporters. Means if it's an old customer, you can reduce any amount subject to it is satisfied about the genuineness of the request provided the exporter is an export import business for last 3 years and the track record is satisfactory. And second part, the export bills outstanding in the account is not more than 5% of the average annual export turnover. Now this is important. The amount which you reduce for the exporter, if it's an old customer, then you can reduce any amount, but that amount should not be more than 5% of the annual export turnover. Okay, more than 5% of the annual export turnover. Got it? So new exporter 25%, old exporter unlimited, but not more than 5% of the average turnover for preceding 3 years. Okay. In case of foreign currency bills, the value date of the credit is taken as date of credit in bank's nostro and interest charged up to this date only. Now, what do you mean by this? Say this. Nostro account means what? Suppose if SBI maintains a nostro with Citibank, USA. Okay. So in that case, what happens? The funds will be credited in Citibank's nostro account, means SBI's nostro account with Citibank. There the funds will be credited. But the problem will be you when will you get it in India? It'll take around 2-3 days more for conversion from Nostro to INR account. Okay, so that's what is told by RBI. RBI says whenever the funds are credited in Nostro at that date itself, you must stop the that finance interest charging. Okay, so here I'll give you an example because this is something difficult for you to understand. Nostro. Suppose let's say I am SBI over here, okay? I am holding Citibank, Nostro with Citibank, Citi, and I am SBI over here. So what is happening? I am holding a Nostro account with Citi over here, with Citi. Now the buyer gives the payment to Citibank. Buyer gives the payment to Citibank, okay, in Nostro. Now the Citibank will convert these dollars to rupees, okay? Rupees and then give it to SBI India account. Okay. So this generally takes 3 days. 3 days. Okay. Now if imagine the finance is for 1 crore dollars, 1 CR dollars. Okay. Then for 3 days, the interest will be huge. Unnecessarily, this seller will be paying this interest on finance. So what does RBI say? Whenever you get any funds in the Nostro, immediately on that day itself, you must stop the interest charging to that customer. Otherwise, what will happen? You will unnecessarily charge 3 days interest to that customer. Okay. So that is the meaning of this. The date of credit in no bank's nostro and interest charge up to this date on the advance allowed against a particular export bill only up to the credit in the nostro. Okay. Foreign currency accounts are in foreign countries. One second. Yeah. Foreign currency accounts in foreign countries or in India by the exporter helps to that is open to save the foreign exchange fluctuations. Now, what is this foreign currency accounts? Mainly for exports, you have EFC accounts. You'll get a question on EEFC, Exchange Earners Foreign Currency Account. Okay, let me see. We might be having. See this. I have written it over here. We'll come to that. So these are prepared to. These accounts are open to save on the currency fluctuation. What happens is, suppose if you are the exporter over here, and what happens, you also import. Suppose let's say I am the exporter over here, exporter. Okay, and what do? I also import from somebody. So what happens if I export the goods? I send the goods. Okay, then I'll receive the payment in dollars. So what will I do? If I'm not having this foreign currency account, I'll convert these dollars to rupees. Okay, and keep it in my savings account or current account. Then I have to buy something. I'll send money. So that person will again require dollars. So what will I do? Convert the rupees to dollars. Okay, dollars. So what am I doing? I am converting over here also, converting over here also. To two times I'm having the losses. So what does RBI say? Don't do this. You prepare an EFC account, and whatever dollars you get, you keep it in that EFC account only. And whenever you want to give the payment, give from that account only. So amount is in dollars, you won't lose on this exchange rate. Okay. So these can be open to save the exchange rate fluctuations and also operating cost, time of bringing proceed, blah blah blah. Forget it. Important part is exchange fluctuations. Okay. Particulars in the international trade finance exhibitions has been allowed on a temporary basis. Now this is what, say this 1 month. Yeah, this was the important part. Say this. Whenever any customer goes for any international trade or exhibition, suppose if you are the exporter, you go for international trade in Europe and do some, there is a trade fair, you go there and you sell the goods, okay, over there only. So what does RBI say? The balances in these accounts have to be repatriated to India within 1 month from the close of that exhibition. This 1 month is very important. So within 1 month you have to get back the funds to India back. Okay, that is important over here. Remember this 1 month figure. Okay, which of the following is true regarding DDA account? Now again you will get a question on DDA account. Okay, diamond dollar account. So remember, important part is I'll just give you the important things which are mentioned over here. See here, first is 5 DDA account. This is an important term. Then second, export turnover should be 3 crores. This is second one, and it should be in the last 3 years. These are the three important terms. Okay. So now we'll read this. Exporter importer dealing in rough and polished diamonds or diamond studded jewelry can open up to 5 DD accounts. So see this, rough and polished diamonds, both of them, the one who is the exporter for rough diamonds or polished diamonds or importer also, can open up to 5 DDA accounts in any bank. Okay. Exporter should have a track record of at least 3 years, and average export turnover should be 3 crores and above. Minimum should be 3 crores. So he can open a DD account with an AD. AD means a bank, okay, authorized dealer, for transacting in the foreign exchange. So remember, DDA, these three important points. 5 DD accounts can be opened. 3 years should be the minimum this period of his stay in the business. Next is minimum turnover should be 3 crores. Okay. Who can open EFC accounts? Okay. Now this is about DDA. Second is EFC. Any person or resident in India who is a earner of foreign exchange can open in this DDA EFC account. Now we'll say earner of foreign exchange means what? Isn't NRI an earner of foreign exchange? But NRI can't open EFC accounts. Okay. NRI can open only NRE, NRO, and FCNR accounts. These are the three accounts which the NRI can open. There is also one more RFC, but that is separate. So NRI can open only three accounts: NRE, NRO, and FCNR. But what is this EFC then? Exchange earner means I am in India, but I am earning dollars from somewhere. So then I can open this EFC account. So can open is a earner of foreign currency. So how many EFC accounts can be opened? There is no limit. Unlimited EFC account. For DDA it is 5 DDAs. Okay. For EFC it is unlimited EFC accounts. Okay. So I'll write it over here. How many EFC accounts can be opened? Unlimited. Unlimited EFC accounts. Okay. And DDA there are 5 DDAs. Okay. Got it everyone? Good, yeah. Congrats, Gaurav. Thank you for your layman language. Okay, yeah, that's the main part. Simple part means explanation should be such that it should be understood by everyone. Then only it's explanation. If I make it tough and explain you to in some Citibank language or DBS Singapore language, which I was, then you won't understand anything. Okay. So next, how much of the foreign currency can be credited to EFC account? 100%. Now, what do you mean by EFC here? Logic is very simple. I am the exporter. See here, I am the exporter over here. I'll write it over here. I am the exporter. Okay. I've opened the EFC account. I've opened this EFC account over here. Why have I opened this EFC account? Why should I open this EFC account? To prevent the conversion. Means I'm getting it in dollars. I'm getting money in dollars. and I have to pay to that importer, means to that person again in dollars. So to prevent the reconversion of these dollars, I am opening this EFC. So how much amount can I credit it in EFC? Only 100%, means complete 100%. Okay, means if I get some 1 lakh dollars from this exporter or this buyer, I can credit full 1 lakh dollars over here. It's not compulsory for me to convert that in rupees. Okay, so complete 100%. Second is EFC accounts are in nature of the current account. So EFC accounts are current accounts. They won't pay you any interest and not non-interest bearing. Balances in EFC can be used for any current account transactions, including repayment of the packing credit advances, whether availed in rupee or foreign currency. So if I have to pay back my packing credit, say this, if I have taken some loan from some bank, okay, pre-shipment, post-shipment finance, so that I can pay back through my EFC account. Now let's come to what is this pre-shipment and post-shipment finance is. Finance allowed to an exporter to fund the expenses needed for procurement of raw material, manufacturing, packing, local transportation, labor charges, all expenses up to the stage of packing and shipment is called as pre-shipment credit. Okay. Now understand this important concept. What is pre-shipment and post-shipment? Okay. So it is like this. Pre-shipment means I'll show you by drawing over here. Hold on. Mm, one sec. See this. What is pre and post? Here. Whenever I am the manufacturer, exporter, okay. So I'll prepare the goods over here. Prepare. So after preparing, what will I do? I will ship them. Ship them to this. I'll prepare first, then ship them to the to the buyer, and then that buyer will the goods will reach the buyer, and then the buyer will pay me right afterwards. So what is pre-shipment now? Before shipment, see here, before shipment, whatever is done is pre, and after the goods are loaded in the ship, whatever happens is post. That is the difference. Pre means before loading. Post means after loading. See this. That's why the definition over here is procurement of raw materials, manufacturing, packing, local transportation, labor charges, all expenses up to the stage of packing and shipment. Okay. So always remember pre-shipment is given not more than 75 to 80%. In exam, the question today will be doing some problem in the evening. Okay. In exam, it is always given, it will always be given to you, whether it's 75 to 80%. But post shipment is always given 100%. Okay, complete 100%. Okay, yeah. Finance against export bills when the shipment is already made is called as post shipment credit. Pre shipment finance can be of two types: packing credit and advance against government receivables. Now, what is this finance packing credit or advance against government receivables? Means what? Whenever I do some export, so government gives me subsidies. Okay, subsidies. Now these subsidies take some time to reach me. They take around 30 days, 15 to 30 days. Okay. Nowadays it has been reduced. It has now come to 15 days. Earlier it was 2 months. Now it is 15 days. Take roughly 30 days on an average. So these 30 days, I'm in a loss, means my liquidity is in the problem. So for these 30 days, we will finance that customer. That is called as duty drawback. Okay. Whenever the subsidies are to be received back by the customer, these are called as duty drawback. Duty means what? Subsidies. Subsidy drawback, you can call it. Okay. So pre-shipment is done for two parts always, packing credit and duty drawback. Even post-shipment is done for the same thing. Okay. Post-shipment can also be done for duty drawback. Remember, post-shipment also has the same logic. I think so over here it might be given. Post shipment can be of various types: export bills purchased, discounted, negotiated; advance against bills sent on collection; export on consignment basis; and undrawn balances or duty drawback. See here again, because duty drawback can be subsidies can be given anytime by the government during the pre-shipment phase or post-shipment phase. Okay, so in both the cases, uh, this finance is to be made available to that customer. So what is this now? Bills purchased, discounted, or negotiated. Understand this concept very clearly. Post shipment finance can be of various types. Export bills purchased, discounted, or negotiated. FBP, FUBD, and FBN. See this. These are the three words: FBP, BD, and FBN. Now remember, what is it for? FBP is always for the site bill. FBP is always for the site bill, site. FUBD is always for the collections. And FBN is always for LC business, LC, okay? LC is N, here I have written it over here. LC is N, collection is D, and site is P, okay? So, collections comes under URC, LC comes under UCP, UCP is 600, and collections is URC 525 we call it, but it is under URC, okay? So only remember for CIB, only these names are important. FBP, FUBD, and FBN. They give you these names, but all mean one and the same only. That is financing. Okay. Advances against bills sent on collection means whatever I have sent it for collection, that's covered here only. Consignment basis and duty drawback. Same logic of duty. Normally, total period of packing credit should not exceed 180 days. Banks can grant an extension of 180 days up to 360 days based on the assessment and need of the customer. Any extension beyond 360 days would cease to qualify the concessional rate of interest to the exporter ab initio. Now, what does this mean? See, here, these words are difficult, ab initio and all these things. It means what? Suppose if I am the exporter, okay, I have sent the goods, okay. So if I am the exporter and I have sent the goods, so this pre-shipment finance will be given to me by the bank for how many days? Maximum 180 days. Within 180 days, I must get back the money from that exporter, number one, or I should get some post-shipment finance on the same. And then only after that packing credit should be closed within 180 days. Banks can grant an extension up to 360 days, means up to 1 year they can grant the extension, but beyond 1 year, it's not allowed. If any pre-shipment finance goes beyond 1 year, the rate of interest, concessional rate of interest, here pre-shipment finance and post-shipment finance have the concessional rate of interest because they are given the subsidies by the government. But if it goes beyond 1 year, then the subsidy is gone. Then you have to charge at the commercial rate of interest. For other customers, what do we charge the commercial rate? Same rate needs to be charged to this exporter. And that also ab initio. Ab initio means from the day one. Okay. Now, what does this mean? See here, it means that, one sec. Let me show you. Ab initio is an important concept because, one sec. It's like this. Ab initio means, suppose if I am the exporter, okay, and you are the bank. And what happens? I have done the export and given the documents to you, submitted the documents, okay? And you have financed me now. Finance, rupees you have given it to me. Now, this pre-shipment finance can be up to 180 days only, 180 days maximum. So after 180 days, I need to bring the money from that buyer and give it back to the bank. Okay, number one. Or second option is I can take a post-shipment finance from this bank only. See here, if any customer is given the pre-shipment finance, you can definitely give the post-shipment finance also. It's not that the customer should get only one type of finance because both are different terms. So how does the bank work generally? See this. This is the before shipment pre and this is post. So what does the bank do? Bank first finance pre-shipment and then after 180 days or before 180 closure of 180 days, bank will sanction the post-shipment and close the pre-shipment. Remember, close. Suppose if I had given you $80 as a finance and if I give you the post-shipment of complete $100, so what will I do? I'll first close this $80, means my earlier loan will be closed, and then remaining $20 will be given to that customer as a loan. Okay. So post shipment finance is used to close this pre shipment finance. Okay. Always remember this. So pre should be closed by either post shipment finance or EFC account also. If I'm having some funds in EFC account, I'll close that, isn't it? So Beyond 360 days, if my this period of finance goes beyond 360 days, then the rate of interest commercial means discount rate of interest which is given to that customer, it vanishes. Generally, the discount rate is 6% and commercial rate is going on is 9%. So what does RBI say? From the day one, then from the day it started, charge that customer by 9%. It's not that after 1 year he'll be charged 9%. He'll be charged from the day one at 9%. Okay. Following is correct regarding the calculation of pre-shipment finance. If the contract is on or LC is on the CIF basis, the FOB value will be arrived at after deducting 13 to 14% from CIF. If the dispatch through sea and around 25% of this dispatch is by air, after arriving at FOB value, the usual margins are done. Okay. So we'll solve this in the problems in the evening. Okay. So what are these? What does it say? It says that whenever I'm doing some finance, and there are few Incoterms. I'll explain Incoterms in the evening. CIF basis and what is all these terms. Okay. That I'll explain it in the evening. Okay. So we'll carry on this topic in the evening. Okay. Along with the case studies then. Chalo, bye from my side now. Time 8 to 10. 8 to 10. Okay. 8 to 10 evening. Chalo, bye.